This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, March 3rd, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, Baker Hughes, CME Group NYMEX. We'll break the report down according to the 5 regions tracked by EIA, beginning left to right with Pacific, Mountain, Midwest, East, and then South Central that includes Texas and Oklahoma, the primary producing area. Then we'll conclude with looking at the overall 48 United States. Highlights from this week's report: 48 BCF drawdown. All regions experienced an increase in their surplus. 3 of the 5 regions in the lower 48 set a new record surplus, and we're nearing the end of drawdown season. Let's go to the charts. All the charts are constructed the same, with the heavy blue line representing the gas and storage, the black dash line in the top pane, the 5-year average of gas and storage, the light green dash line, the 5-year average maximum, and the light red dash line, the 5-year average minimum. In the center pane, the bar graph represents either an injection or withdrawal. And then in the bottom pane, we look at the surplus or deficit, which is measured as the difference between the gas and storage and the 5-year average. Beginning with Pacific region here, there's 255 BCF in storage, and that's just roughly below the 272 BCF 5-year average maximum, well above the 211 BCF 5-year average. In the center pane, there was a 1 BCF drawdown, and the surplus in the Pacific region has expanded to 44 BCF. In addition to the storage, we take a look at the delivery points that are in the respective regions. We look at the basis differential. In the Pacific region, we have 2, the PG&E and SoCal. PG&E is stable this week, and SoCal continues to trade at a discount. Mountain region, 145 BCF in storage, is now above the 5-year average maximum after only a 2 BCF drawdown and a 19 BCF surplus, which is a new record for the Mountain region. The basis differentials are both trading at wider discounts than they were last week. Midwest region, 621 BCF, another region that's slightly above its 5-year average maximum after only a 24 BCF drawdown, and the surplus here is widened to 184 BCF. Only one delivery point we look at in the Midwest, that's MidCon, and it has actually expanded to a slightly larger premium than last week. The Eastern region at 495 BCF is halfway between, or actually a little bit closer to the 5-year average maximum of 536 BCF with a 17 BCF drawdown. The surplus expanded here as well to 99 BCF, but that's not yet a new record for the Eastern region. 3 delivery points we look in on in the Eastern region. 2 of them have been trading at a deep discount ever since the middle of 2015. I did want to take a look at Transco, though, because this is one where we started the year here at the first of the year at $2.50 premium, and for the first time this year, and actually first time in about 13 months, that it's trading at a discount. So you can see the ample surplus of gas in the east. There's also some new infrastructure in place up there to help move the gas from Marcellus north to the population centers up there, and that's beginning to be reflected in all 3 delivery points in the eastern zone. In the South Central region, remember this is the producing or primary producing area with Texas and Oklahoma. Still have 1 trillion cubic feet of gas in storage with only a 4 BCF drawdown, and we've expanded to a 319 BCF surplus, so nearly a 30% oversupply in the South Central region. Not shocked to see here that all 4 delivery points are trading at widening discounts. The lower 48 United States, I've added some things to this chart and made some modifications, so I'd like to spend some time on it with you today. We are coming near the end of drawdown season. When we go over here to last year, over here toward the left of the chart, if we look at around the 27th of February, and then into the 6th of March and the 13th of March, we actually drew down just a little bit of gas as late as the 27th. But you can see that right in here, we are coming to where we will probably only have 2 to 3 more weeks potentially of drawdown, and we don't. And typically, the last couple of drawdowns are not huge by any means. So One of the things that I've done here is first thing I did was I adjusted the all-time maximum. The highest storage we've ever had, just over 4 trillion cubic feet in storage, occurred at the start of this drawdown season, so we've marked that. But I've added an additional line here, the brown dashed line, 2.37 trillion cubic feet, and what that corresponds to is we have to go all the way back into 2012 to see what that corresponds to. And so you can see in March 2012, we began injection season at 2.369 trillion cubic feet of gas. That's the highest we've had in about the last 10 years. And right now we're at 2.5 trillion cubic feet. Hard to say if we get all the way down to that 2.369. Seems highly unlikely, though. That's almost another 200 BCF of gas, and at most we're looking at probably another 3 weeks of drawdown. So, considering an average of 70 BCF per week or so to get us down there, it's going to be very hard to do. So, I anticipate that we'll start injection season probably at a new record level. That'll certainly put a lot of fundamental pressure on prices. But that's the change I've made to the chart this week, and we'll continue to track this over the next couple of weeks as we transition from drawdown into injection. In the bottom pane, 666 BCF surplus. That is a new record for the lower 48 United States. And in the center pane, what we talked about at the top of the report, just a 48 BCF drawdown this week. Exploration and production activity is measured by the Baker Hughes rig count. This is the North American rig count. So this is all rigs in North America exploring for gas or oil. Stacked out 14 rigs last week all the way down to 473. I've used that same convention with the brown dashed line and extended it all the way back, and we have to go all the way back to July of 1999 to find a similar depressed level of rig activity in North America. Focusing on natural gas, this is rotary rigs in the United States focused on drilling for natural gas. 102, we actually added a rig last week, interesting. The 242 is the lowest level we reached back in 1992, so this 102 is still down there flirting with an all-time low for natural gas exploration and production activity in the United States. Looking in on natural gas prices, the top pane is NYMEX Henry Hub natural gas futures, the data via e-signal. They're a continuous contract, so this is not roll adjusted. And the bottom pane is the 10-year weighted average of annual seasonality. And what I've done with the rectangles there, that's in the drawing tools of Update Analytics. You can put those on your charts, change the color to give yourself a reminder, or for reports you may be sharing with folks, of times when we have seasonal weakness and seasonal strength. The present time we're in from the first part of the year into March, and what this is this coincides with the end of drawdown season. It's volatile with a slight little bit of seasonal weakness. However, beginning the first part of April into the middle of June, we do experience some seasonal strength. Now, last year, you can see there was just a little bit of seasonal strength, and then if you go back to 2014 during this time, just a very slight amount. I don't expect to see any huge ramp up in natural gas, given the fact that we're probably going to start injection season at a new record. But just be aware that as we do get through March and get here into April, that's a time where we might begin to see some seasonal strength in natural gas. The daily cloud chart, really like looking at these. The theory behind these charts is you can glance at them and get a good feel for what the market's doing and how it's trending. The obvious things to see in this is that the candlestick prices, that's the alternating red and white prices, well below the cloud spans. The heavy blue lagging line well below the cloud spans. The cloud spans are negative, as indicated by the pink or reddish highlight on the right edge of the chart, the turning line below the standard line, and the price below the turning line. So every parameter that we would take a look at on this chart is negative, not surprising with that huge storage overhang and the relatively mild winter we've had in the U.S. Shift T and Update Analytics bring up a point and figure chart. This is a 1% logarithmic box size, 3-box reversal, consistent with the daily cloud chart, well below bearish resistance, several intermediate downtrend lines, one active downside target down to $1.57, about 6% below where we're trading right now. And then you can see previously we had several downside targets that were realized. The 60-minute point and figure chart tells a similar story, still well below bearish resistance here as well. Something to look at on the shorter time frame, though, 4 active downside targets beginning with $1.62 and $1.60. So, and on the previous chart, we had that $1.57, so somewhere between $1.57 and $1.60. High likelihood that we're going to visit this range probably right around the time that we get done with drawdown. If we have some kind of record surplus, it'd be a good time to be aware that could be in play. So on 2 different time frames, we do have a cluster here between about $1.57 and $1.62, making this area on the chart highly likely that we will realize that. And then other downside targets we should be concerned with as low as $1.50 or $1.44. This is the 15-minute close chart of the actual futures. This is NGJ6, an IMEX Henry Hub natural gas for physical delivery in April. That same downtrend is well in place. This morning we were down here as low as $1.63, $1.64, a slight spike up on the report, but it's retreating again now. The forward curve for natural gas, this comes to you via the updated energy feed. We've talked before about how we see these seasonal patterns, but for this year, that seasonal pattern has just pretty much been wiped out. If we look at historically, March trades at a premium to April. We can go and see that in all the future years. But yet, if we go here, well, actually, March is off the chart. See if we can bring it up. Nope, that was a month ago. But we are very depressed here on this end of the chart. If we go back 5 days ago in that downtrend, it's not surprising that here in 2016 we're lower at all delivery points. However, going out in the future here, especially kind of interesting in the 17, 18, 19 area that we're trading above. The only reason I can think for that is that with the all-time record low of natural gas rigs and then the century low for total rig count, is that at some point the reduced exploration and production activity begins to constrain natural gas supply. Thank you very much for joining us. This is Brent with Black Lion Capital Management and the U.S. Natural Gas Report for Thursday, March 3rd. If you have questions or comments, please feel free to contact me directly via email. If you'd like to learn more about Update Analytics and the Update Energy Feed, please contact their sales team directly. Thank you and have a good weekend.